Thank you for tuning in to episode 246 of This Week in Real Estate, the TWAR broadcast podcast live Wednesday, September, what is today's date? September 6, 2023. This episode was brought to you by listeners and viewers just like you, so we don't have any way for you to give me any money or anything. So instead of that, all I want you to do is just take a second and share the show. Send it to somebody in the industry, maybe somebody that's in investing, a lender, a title company. Let them know that you listened to this show and you thought it might be helpful for them too, because we have a ton of great news articles and a very special guest today, which we'll get to in a second. If you're watching live on YouTube, you can comment and we can display your comment and talk about you. Or we'll talk about your comment, just like Melissa Mara did. She said she beat Matt today. Where's Matt? Dusty's also here. Thanks for joining us live, Dusty. We love the back and forth. That's why we do the podcast live, is so that we could get your input. Matt said he is here. He was just last. And if you're joining us on Clubhouse, you can also join the conversation and let your voice be heard. It will be on the podcast forever. So thank you guys for joining us in the Clubhouse room. I hope to have a rousing discussion today. And the whole point of the show is to focus on the top real estate news stories so that you have one place to go for the week. You don't have to go to all these other different websites. You got one place to go for succinct, professional commentary on exactly what you need to know in real estate. And this week is no exception, because we have a very special guest this week that I'm super excited about. Literally 15 minutes ago, he had no idea that he was going to be in a podcast today, especially a podcast of this magnitude. So please welcome to this show, Jason Haber. What's up, Jason?
Everyone? Here I am.
Thanks for joining us. Literally last minute.
Didn't even know. Get the call, the bat signal goes off, and boom.
Boom, he's here.
You go down. It's been one of those kinds of weeks for me, so let's just get down to business, I say.
I mean, some of you may recognize Jason, but you may not know him by name. You may know him as the NAR Accountability guy.
Dun, dun, no dun. T-shirt. We're working on merch. It's been a little busy, lower on the priorities.
I mean, the conference merch that you will have is pretty amazing.
We got a guy. Someone said everyone should get merch and then wear it to the NAR conferences, and it'll drive them bananas.
And until they do something. You know.
I mean, yeah, exactly. So, so stand by for merch. No merch though, just me.
No merch yet. Well, we do have. We're going to be diving deep into the article that kind of featured you, I guess, this week on Inman, with the NAR accountability stuff. As people know, we've been covering the sexual harassment and the Kenny Parcels thing. We've also been covering the spending that's happened in the BAM and Inman articles that came out talking about Goldberg getting $2.5 million for being the CEO. Which, I think that's my next, I'm going to put that on the goals list, because, and I told people, they were like, oh, Ray, you should totally be CEO. You'd make some big changes. And I'm like, I mean, honestly, I'm not going to change that salary if I get the CEO position. Just saying, I'm going to take advantage of that. But we'll talk about that towards the end of the show, because we also have a whole bunch of real estate news to get to too. So Jason is going to join me throughout the whole thing. And like I said, literally, guys, 15 minutes. I just sent him a message on Instagram. I was like, and I know it went to your other folder first because we weren't following each other at first. Right. And so I followed you. I was like, hey, you may not get this in time. It's super last minute, but if you want to jump on, you're welcome to. And at 11:45 my time, so the show goes live at 12 my time. At 11:45 my time, he says, hey, I just sat down. What's up? Like, you want to be on the podcast right now? And he's like, yeah, let's go. So I really appreciate you in the last second hopping on. And I look forward to the discussion that we're going to be having today for sure.
Every time I get a message from a guy with a long beard, I'm always ready to roll. So
let's go. It could be your wizard.
How bad could it be?
I'll be your Gandalf. You be my Harry Potter.
Exactly.
All right, so the first article we're going to cover today is mortgage demand. So it dropped to a 27-year low. That's pretty low. So as interest rates actually pulled back this week, but it wasn't enough to keep buyers in the mix. So the total mortgage application volume fell 2.9% last week compared with the previous week, according to the Mortgage Bankers Association seasonally adjusted index. The mortgage applications declined to the lowest level since December of 1996, despite the drop in mortgage rates, said Joel Kahn. He's a Mortgage Bankers Association economist. He goes on to say rates remained more than a full percentage point higher than a year ago, despite the mixed data on the health of the economy and the signs of the good job market. Applications to refinance, which are most price sensitive, fell 5%, while applications to purchase fell 2%. And we are noticing a kind of a slowing of the market. We're noticing a slowing of most buyers, but I still have buyers that are anxious to jump into the mix, that really want to buy a house, but they want to buy the right house. What kind of stuff are you seeing in your, I know you said you're in two markets.
Yeah.
You're in Manhattan and you're also in the Boca Raton area.
Yeah.
Are you seeing a difference, a contrast in those markets, or are they kind of playing the same way?
So there are some differences. So in New York right now, you have a lot of deals that are getting done with all cash buyers who are looking for value. Believe it or not, prices in New York where they are now relative to where they were, call it 18 months ago. It's rare I would actually call parts of New York City the value play, but there is no doubt that there are huge pockets of value. The good thing is, for a while, buyers were so hesitant they weren't stepping into the void. Now I'm seeing buyers step into the void. I'll give you a super quick example. I have a listing on West 50th Street in Manhattan. My client in 2016 paid almost $4 million for it. It's going to sell for almost half that now.
Oh, wow.
Not quite. It was the first time in 17 years I've seen that kind of a decline. But once we took the price down to a certain level, we had several people ready to pounce. So at some point, buyers are stepping in and they're seeing at some point the math relative to the market starts to work. And so I think you've seen a lot of seller capitulation, and I think you have sort of I think Manhattan's in a good place there now to see more transactions. In South Florida, you have this migration pattern happening here, which isn't letting up.
Right.
The reason I got my license here is I was referring so much out to South Florida. I thought, well, I mean, I can do this there. I mean, it's very different than everywhere is different from Manhattan. Manhattan is literally and figuratively an island unto itself. I've discovered. Now that I've stepped off this little 6-mile island, I've seen just how different real estate is in South Florida. But here, the migration pattern has sort of propped up the market in ways that other markets didn't, saw a drop off in, like parts of Texas have dropped off.
Right.
You haven't seen that in parts of South Florida because there's just not nearly enough supply for the demand. So it is different down here. Two different markets for sure.
Yeah, that's kind of what the thumbnail. I should add this. I'm gonna throw my thumbnail into here real quick so I can show it. But that's exactly kind of what I was trying to convey in the thumbnail. We have a couple of news articles that we're going to get to in just a second that actually point out that statistically too, where there is a drastic difference in what's happening in one part of the country versus another. So it's interesting to hear your perspective as someone in both markets. Here, this is the thumbnail. So for the audio listeners, I'm pointing to kind of like it looks like a haunted house, like that house in the neighborhood nobody wants to live in. That's on the left side, and I'm pointing to it. And on the other side, I'm right in the middle. On the other side is a beautiful Victorian home with roses blooming, kind of representing just the tale of two markets that we're in, where you have in some cases these big beautiful homes that are selling at record prices, and in other cases you have these big beautiful homes that are selling at record discounts. And it's a really drastic difference. It goes, the old saying, location, 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 has probably been never more accurate than right now, I would say.
Yeah, I mean, 100%. I mean, I think also the idea of doing work right now becomes more unappealing because the cost basis for that work is higher than it was before. And also the time everything seems to take longer. So tougher on projects. There has to be a real incentive there to take on a big project right now.
Yeah, that's a good point. We are seeing there has been a consistent point where all the buyers are looking at saying, okay, if rates get to this point, we're in. And there was another news article about that today, because the question remaining was, okay, if buyers will jump in at this rate, then when will sellers agree to sell? They're sitting on a 2% or a 3% home. When are they willing to also put the home on the market? Because they may jump in the market at the right rate, but they may not sell that house they had because.
But what's that number
for them? I'm glad you asked, Jason. So then the number is 5%. That's the number that most homeowners say they would be willing to sell their home and move to another one. Now, we talked about this a couple of weeks ago when there was another magic number. I can't remember the group that put this this other number out. It says in here, I'll find out who did the study, but the, John Burns Research and Consulting. So maybe it was a month ago, we talked about the 5.5%, where 78% of buyers were waiting on the 5.5%. That was the magic number at the time. Now it's about 71% of prospective home buyers that are waiting in that 5.5% range. That difference goes to show you that some people may have settled, just like what you said. They're kind of getting used to the newer rates. Well, the price for a seller to jump into the market and to leave behind their phenomenal low rate seems to be about 5% or higher, according to Zillow. So if their mortgage rate is 5%, then they're willing to go. But that's still, like, for me, I'm sitting in a house with like a 2.5% rate, and I remodeled the whole house. We refied at the very bottom, and I don't believe there's any way I would ever sell this house. As long as I'm holding a mortgage on it, I don't see that it's financially viable for me to sell this house, because it's so much cheaper for me to keep and just rent out to someone. And I understand and recognize that I am part of the problem, but part of the problem with inventory. But I think it's just a smarter decision, if you can, to keep what you have. But I think there's this whole other group of people that are saying, well, for me to move up to the point that I want to move up to in the next home, I have to sell to take my equity out and make that move. And I think those are the people that are willing at 5% to say, okay, fine, I'll sell and I'll move up, make the move I need to move, get rid of the house and cash in. I'm assuming Manhattan, you see a lot of cash deals.
Yeah, most of my deals are all cash in Manhattan, just the way my business is.
Yeah. Boca Raton, I'm wondering if that would continue. I guess it probably would in the secondary market.
Secondary, tertiary. I mean, you just have a lot of pied-à-terre buyers or part-time owners, but then you also have sort of northern migration into sort of Palm Beach, Broward, Miami-Dade counties.
Well, and the big remaining question is, okay, if that's the case, if most people would buy at a 5.5% rate, it went viral. I did a reel and it went viral. I had 2.6 million views on this thing.
Wow.
And I was talking about Barbara Corcoran, who came out and said there would be a bloodbath in real estate in the commercial sector. However, buyers, they shouldn't wait to buy. They should buy now, because if it goes down to 5.5%, you're going to see prices shoot up. And it's actually cheaper for you to buy right now, because so many people are waiting on that 5.5% number. And so we did a commentary on that, and I'm still getting comments and people like arguing in the comment. By the way, the comments on that post is a cesspool, and I love it. Like I am trolling the trolls. There, I have some favorite, like I screenshot it after I troll them back, because I'm like, oh, that was fun. So I don't mind it, but I could see, I've been some kind of creator groups, and we help each other, and I could see how someone that is like sensitive to that would be messed up. But the 2.6 million people that have watched that are all arguing it would be dumb. Well, a lot of them are arguing that it would be dumb to buy now, because if rates go down, they don't think prices would go up. But yet there's so many buyers waiting to buy. Well, if that doesn't happen, then you could always just refi at the bottom end. If you buy now and rates go up, then you've bought at a most recent low. So the question remains, what are rates going to do? And I was at the Tom Ferry conference, was that 2 weeks ago?
Yeah.
Steve Harney, with KCM, was basically saying, hey, all the economists, they don't know. They don't know what's going to happen with rates. But we got a little bit of a hint today. So Redfin put this, I guess this came out on September 1st, but Redfin says a rate hike is increasingly unlikely after that week's job reports. So it's seemingly weak. Here, let me share that. Yeah, this is the right article. Okay. So this week's job report is seemingly weak at first blush, but it's actually fairly good news for home buyers waiting on mortgage rates to come down. The U.S. added 187,000 jobs in August, in line with expectations. Unemployment jumped significantly from 3.5% in July to 3.8% in August. That may alarm people, but the jump is most likely due to people who are looking for jobs, not more people that are losing their jobs. Wages slowed. So basically, a bad jobs report in this context is good for people that are wanting a lower rate. And that's the Fed has they have two jobs: prevent inflation and keep people employed. And the more people that are employed, the more money that we have in the economy to order stuff, the more people who order stuff, then the more prices start to go up. And so they have to, it's a natural consequence of a interest rate increase that people would start to lose jobs. Are you, Manhattan, New York, are you seeing a whole bunch of job losses? Are you seeing the economy negatively impacted by the rate increases, or is it still kind of normal?
It's a new normal. So we've always been, there's certain cohorts of the market, particularly, it sounds ridiculous, but this is just Manhattan, 10 million and up, 20 million and up is a market cohort. It's not an outlier of a price point. It's almost always all cash. It's almost always been all cash, and it still is. That hasn't changed. What you're seeing now is people looking under that price point to be more all cash, whereas before they would look to take on hefty financing. My question to you, though, is if rates do come down, counterintuitively, I wonder, I know everyone says that'll send prices up, up, up. But my question to you is, if inventory gets flooded in certain markets, not every market will have the buyer demand there to meet the inventory, which actually would take prices down. Correct. In some markets.
Yep.
So you would have to have excess buyer demand in that market for an interest rate drop to plus inventory increase to absorb that new increase.
Right.
I don't know if that's true in all markets. It would be in South Florida that would work. I don't know about other markets though.
We are so far behind in our market that it would take years for them to recover. I mean, the builder used to build. I don't know what builders used to build. 1.4 million homes a year. Now we're at like 700,000. So we're still half of what we're normally building. And I think after 2008 and 9, builders have never kind of recovered that pace that they used to. I had a buddy of mine that, he had a white pickup truck and a flip phone. So he became a contractor and threw up 100 houses a year. He's not doing that now.
Right.
Now he's a project manager for a bigger build company, and they're still slowly putting out homes. So I think it would take a lot of inventory to flood the market in order to satisfy that buyer demand. I just don't see that buyer demand being easily satisfied in most markets. But I think in market segments, I think you will see an increase in that demand satisfaction, I guess you could say. For instance, a super high end, I think you're going to start to see a lot more demand being satisfied on that high end where those prices are coming down. But in the bottom 1/3 of the market, it's still, there's still a glut of inventory because builders aren't even building there. So I think it would be the midsection in most extremely populated areas that are having an outflow of people.
Yeah.
That middle market would be a really good buy for investors in the future because that's what's going to start ticking down, I think.
Right. Workforce housing too is really important in a lot of these markets where there's not enough of them. And, there's always going to be a need for that. And if prices come down there, that's probably, for investment, an interesting opportunity.
Yeah. Dusty Martin, she's in Arizona. She says, we didn't build homes for a decade to keep up with the population growth.
Right. It's a huge problem for affordability.
Yeah, it'll be a feeding frenzy until we build more. I actually met with a local builder here, and they were basically asking, like, what's your take? What's going to happen? What are we seeing? And I told him about the interest rates and people kind of, pulling back a little bit from buying, but being a lot more particular. And then I sent him this article today, and I said, look, most homeowners aren't going to list their houses until they're looking at a 5% rate. And he said, oh, okay, so I just need to hang on until then. I was like, no, you're a builder. I'd build as fast and furious as possible.
Right.
But when you start to see rates hit 6, slow down a little bit because now you're going to have increased competition entering into the market. Mike, what's up, Mike? He says, depends on why interest rates come down. Severe recession with high unemployment might only be corporate buyers. You could see a lot of corporate buyers pull out. It got to the corporate and big investment firms got to 22% of the purchases in 2022. It was previously like 13, and the year before that it was 15. So it's now gone back down. So they've already pulled back some. They're not buying at the same pace that they used to. So if you did see the corporate buyers pull back, you would have some inventory coming back onto the market. So that could help. But even aside from 2 recessions, home prices increase 3 to 6% in every recession. So one of them, of course, was the housing-led recession of 2008, where home prices went down 19%. The other one was a recession, I want to say it was in the 80s, and home prices went down negative 1.9%. So
probably the 1982 recession.
Yeah. However, some mommies and daddies are helping out. Nepo-Homebuyers. 40% of under 30s received family money for a down payment. I love this because it shows, there's a lot of times we preach about the wealth building possibility of real estate and what it could do for you and that kind of thing. And I'm wondering how many moms and dads like refied at the super low rate of 2% and they have this money sitting there and they're like, okay, I'm going to give this to the kids so that they could buy a house.
So it's great you mentioned that. My aunt Tony Haber and I, we created this network, this programming called the Haber Network, where we focus on generational wealth transfer, because the largest generational wealth transfer in history is about to begin. And so Tony and I have created this program specifically for families, so they can have conversations about wealth transfer, what kind of legacy they want to build for themselves in real estate. They're hard conversations to have, but this wealth transfer is underway now, and there's no denying that families are helping their children or grandchildren with purchases. They're buying it together. They're gifting money. There's a lot of different mechanisms that they're using, putting it in trust, and navigating that right now is a real part of our market, and that's why we just for them.
That's very cool. I didn't even know that when we were planning the show today.
You check out the habernetwork.com where we on our website where we do I do lots of stuff, man.
Yeah, no, you're a very busy guy.
Very busy guy. We can get Tony on to talk about it too sometime. But what we're finding is that families want to know this information and want to know how to have these conversations, and what they should be doing, what they should be thinking about, and how they go about doing it. And we help them with that.
That's very cool. Well, it's helping a lot of home buyers right now to buy homes that are kind of unaffordable for most first-time home buyers, as they're taking the gift funds. 23% used a cash gift from family members, 21% used inheritance money for their down payment. So that's really interesting. That's cool. Yep. There's another article about the changes in markets. So I have two juxtaposing articles. First, we're going to dive into San Francisco. 1 in 8 San Francisco home sellers are losing money.
Wow.
Yeah. Stark contrast to what it used to be over there. San Francisco home sellers are 4 times likely more than the average U.S. home seller to take a loss as the Bay Area metro reels from the outsized drop in home prices. Typical San Francisco seller who takes a loss sells their home for $100,000 less than what they bought it for. So that's 12% of the homes are taking a loss in San Fran, compared to 3% nationwide. So the big major metros that people are moving out of are the ones that are really taking the hit. The vast majority of U.S. home sellers are still reaping gains, though. So it does say that even though home prices have fallen near their peak, the majority of home sellers are reaping significant financial gains. Nationwide, 97% of home sellers sold for a profit for the 3 months ending in July 31. With a typical home that sold going for 78.4% more than the seller bought it for. And this is on Redfin. You guys can go there. They have all the metro data. We have a lot of Atlanta listeners, so I'll tell you that only 2.8% of the homes in Atlanta went down. A lot of Texas listeners too, but you guys are all listed by city there. So take a look at Redfin. It's got more information there. So the other one I want to run right into is Miami home prices. So Redfin also has an article on this. Miami home prices, as you can imagine from working in Boca Raton, it's the complete opposite story.
Yeah.
Miami home prices are up 17% from a year ago. So nationwide home prices are up 5% year over year, biggest annual increase in 10 months. Median home sale price in Miami rose 17% from a year earlier during the 4 weeks ending in August 27. It's the biggest increase in the metro area since October of 2022. You'd think it's been a longer time, but we forget, during the pandemic, it was nuts. Everyone was raising home prices everywhere. But it's a complete opposite. Oh, let me share this chart too. It's a complete opposite story of a place like San Francisco, which is actually seeing homes sell for less. The red number is the national. Is that the national average? Yeah. So there's the U.S. average is up almost 5%, but Miami's sitting at 17.1. Which you would say, well, that
Hey,
creates
Ray.
yeah. Go ahead, Eureka.
Oh, sorry. Just to chime in really quick, because I'm from the Silicon Valley, San Francisco itself is really having a problem because of all of its homelessness, and people are leaving like that city in particular. But it's not true for our surrounding areas in the Silicon Valley, is what I would say. Like, we're seeing so many super high end sales in our little tiny market. I'm on my way to go see an $11 million house. We've had several in the high end range sell, and homes are selling at all ends of the market. But I would say I would just add that little asterisk for when you're talking about San Francisco.
Yeah, that's smart. I think you're right. The major metros. I remember I think this was last year when we covered it, but there was a study talking about where people are moving, and they say so many people are kind of staying in the same zip code, but they're moving outside of the major metro areas. So they're staying in the same zip code, but they're getting as far out of the most populated areas as possible. And I wonder if some of that is kind of what's happening in the San Francisco area. I've never been to San Francisco, so I'm not sure if it's like, coast to coast of the code of the zip code, if it's all full and all going through the same thing. But I would presume that you're absolutely correct, Eureka, that the other areas surrounding San Francisco may actually be reaping some of the benefit of people moving out of San Francisco as a whole, which kind of goes back to what we were talking about at the very beginning, Jason, where, real estate being local, it is right now, as you're seeing these extreme differences around the country, I think you'll probably see extreme differences from neighborhood to neighborhood and zip code to zip code, and then an area like Silicon Valley versus San Fran.
Yeah, I think it's very possible. I mean, I'm not familiar with. I know San Francisco, but I don't know the geography of the local market there that well. But that sounds right.
Well, since you are in New York, you may have an opinion on this next article too. Airbnb, the short-term rental laws are in effect on Tuesday. So let me bring up this article. I would love it. I don't know if you know all the details of this, but New York City's short-term rental crackdown went into effect on Tuesday. Although the law applies to all short-term rental platforms, news coverage is focused on Airbnb, of course. New York City's new short-term rental rules are a blow to the tourism and economy and thousands of New Yorkers and small businesses in the outer boroughs who rely on home sharing and tourism dollars to make ends meet. How do you feel as a New Yorker about the Airbnb deal?
So their affordability is a huge problem in New York, and it's a massive failure of the public sector that we haven't built more affordable housing, and we continue to lag behind there, which is why one-bedroom rentals in Manhattan now, the average price is over $5,000 a month. It's completely unacceptable, and it's completely unaffordable. Now,
you can rent a house in Hawaii for that, by the way. The average rental in Hawaii is $5,000 for a whole house.
So now you take that and you say, okay, so people trying to make their homes more affordable, they use Airbnb for the extra income, which I understand. So the problem is when you're in a building, though, you're part of a community in the building, and apartment houses are not hotels. They're not supposed to be transient like a hotel is. And so you have quality of life issues and livability issues if every 4 days you have a new neighbor. If you're in 12B and 12A, it's a different person that's not the deal in living in an apartment house. So you have to balance this affordability issue that folks have with the quiescence of living in an apartment building that you're paying a lot of money for. And the problem with the Airbnb usage is that it changes the nature of apartment living, and that's been a problem. So the city is now going to crack down. I, by the way, have no idea how this gets enforced, because how do you prove that the owner wasn't there? I mean, I don't know. It seems very difficult to enforce, but I'm sure they'll make examples out of some people to show that there's levels of enforcement. I mean, I guess. So it's a complicated issue, and unfortunately, they're in conflict with each other. Like, both things are true and both things are in direct conflict with each other. So I don't see how you resolve one without hurting the other. And in this case, the city council and the mayor decided that the livability of buildings was really important, and they didn't want the transient nature that comes with Airbnbs. So so that's why. And I understand the position. Affordability, though, should not be solved by renting out your apartment to someone else as a sharing.
Yeah.
It should be solved by building more housing and thus reducing. I mean, it's just economics that you took in the 8th grade, right? Like supply and demand. You need to build more housing to reduce the costs, and that's the way the long-term solution here.
That's what Julie Moon said too. She's in Athens. She says in Athens are only about 10 houses being built in the greater Athens, Georgia area. And then she goes on to say builders should build fast and add a buffer for the buy down to buyers. The 2-1 buy down or 3-2-1 buy down. Yeah, that's the solve. I agree.
But there were, the permits, if you look at what the construction plans are in Manhattan right now, they're paltry. They're nowhere near. You need to build at scale thousands and thousands and thousands of apartments, of units you need to deliver.
Yeah.
And until that's done, by the way, there are just in Manhattan alone, there are over 1,000 vacant lots just sitting there that the city owns. 1,000.
What are they going to do with them?
They're just sitting there. I don't understand why. The former controller for the city, Scott Stringer, did a great report on this, outlining an affordable housing plan that relied on using the vacant lots and building 100% affordable, which I thought was a great idea. But until you get serious about building, we're going to be on this vicious cycle of higher rents and people struggling to pay those rents. So they're either going to leave, which is bad for the city, and then eventually brings down rents because people just leave. Or you flip it around and you build more to have more folks there, which is exactly what you want. But you need to do it. You need to do it.
Get one of those big 30,000 person apartment complexes like in China.
Like the size of some cities.
Yeah. All right, so let's dive into some industry tea. First up is a character that we've talked about on the show before, who's being sued. And I think this is not the first time. But Mr. Grant Cardone, who I famously pointed out at the same time Susie Orman was saying don't buy houses, Grant was saying don't buy houses. And they were, not only were they wrong, this is right as the pandemic started. Both of them came out and said, don't buy houses, the market's going to crash. Not only were they wrong, but if you took their advice, you lost so much money because you could have bought a house and then sold it 2 or 3 years later and just pocketed a ton of cash. Anyway, he's getting sued for some investing practices. Basically, a guy tried to sue. He passed away. His daughter's taking up the lawsuit now, and they're turning it into a class action lawsuit against Grant. So a lawsuit adds that Cardone continued to conduct misleading practices even after being warned by the Securities and Exchange Commission that he needed to adjust his marketing in order to continue his investment business legally. And that's why, you'll see a lot of TikTokers and Instagrammers and people that talk about investors now, they have either in their bio or sometimes at the very end, it's just a flash real quick of a whole bunch of text. And it's their legalese. They're basically saying, don't take this advice.
Right. It's not financial advice.
Right. So in the type of syndicated investments that Cardone was promoting online, his followers can invest funds for as little as $1,000, and Cardone pulls the capital, uses the funds to get a loan, buys undervalued rental properties, and rents it out. So he's basically playing the same game that a whole bunch of big equity groups are playing across the country. But there's a complaint that the way he was doing it is basically misleading those investors. So I'm not sure what the end result was. It doesn't say in the article if they actually built it or not, but I'm assuming that the guy didn't get his money back or didn't get the investment back. But it was a $5,000 investment that the guy made and lost, and that's what's bringing the suit. And now it's a class action suit for anyone else involved. So there's a whole article on this on Inman. Have you ever had any run-ins with Grant Cardone and any of that?
I have not. I've not invested any money with him. I don't know anyone who's invested any money with him. So I don't have any personal experience.
Me neither. But if you are somebody that does, you can just ask Jason. We'll have you right on the show in a 15-minute warning.
Very fast. Just be prepared to talk.
Just be prepared. All right. We also have a lawsuit settlement. Anywhere, who is Realogy, old school Realogy, new school Anywhere.
Big news here.
They settled the bombshell Sitzer and Moehrl commission lawsuit. So this is the one that was happening in Missouri. It became class action. There's a whole bunch of real estate agencies that are involved. Let's see if I can find the list. I think Keller Williams, hang on.
NAR is a member.
Yeah, NAR is a member to it. There it is. Keller Williams, Anywhere, Remax, Home Services, and Home Services subsidiaries, BHH affiliates, HSF affiliates as defendants, and the National Association of Realtors. It was filed in 2019, got class action status April of 2022, and Anywhere was like, we're out, we're settling. So they folded faster than a cheap suit, even before trying to get, I understand why, right? They're risking millions of dollars at the opinion of a judge. And if it doesn't go their way, it's going to hurt a lot worse than if they were just to settle it.
Yeah, no, 100%. But do we know we don't know what the terms were. So,
we
right.
Won't know what the terms were yet.
We don't know if they're like, how does this impact buyer agency? I think that's the big question. Aside from the dollar amount, that's the big question.
Well, Anywhere came out and said, let's see, it agreed to settle the case against its nationwide basis and charges and change its practices, it says. So it's going to change its practices. Yeah.
But I don't know if that means
that's a key component of this statement. I think.
Are there just disclosure form? I don't know. We have to see, because if they're going to change buyer agency,
they can't do it from just one company.
Yeah, I don't think they would have settled it with getting rid of buyer agency. I mean, let's face it. I think they're pretty smart folks over there. So I assume that whatever it is, it was much better than the risk of going before a judge. So it's all the devil in the details, man. I mean, that's what we got to say.
Yeah, there's $6.7 billion at stake in the trial in Missouri alone.
Yeah.
Anywhere says, they go on to say that they have established itself as the voice of reason in the real estate world, and they urge other corporate defendants and companies around the United States to follow. I mean, of course, the real winners here are the attorneys that are bringing the class action lawsuit. I should have a different job.
And they know it too. You hear those statements. Oh boy. Yeah.
So we'll see what happens if other services, if other litigants decide to settle. We'll update you guys. We'll know, as there's a document that has to be filed with the settlement, and then the plaintiff has to urge that it be accepted by the judge. And when that happens, that's when I think we'll hear the details of the settlement. Possibly. I guess they could seal that, but I don't know why they wouldn't. NAR, Montel Williams says, the settlement is always an option for any party in the litigation. Montel Williams said, NAR's commitment to defend ourselves in court remains unchanged, and we are confident we will prevail in providing lawfulness under the rules that are under attack. Pro-competitive, pro-consumer, local MLS, broker marketplaces ensure equity, efficiency, or efficacy, transparency, and market-driven pricing options for home buyers and sellers. I don't know. We'll see what happens. This is just one lawsuit. I think there's like 3 going on right now, and 2 of them have received the class action status. Maybe even all 3 by now.
It's a very challenging moment, and there's a lot at risk here. And in my opinion, NAR's sole focus should be on defeating these lawsuits and nothing else.
I agree. Well, NAR, one other thing that they released this last week is that they're committing to stand behind Mr. Bob Goldberg, the CEO of NAR. I can hear Jason getting revved up right now. After the resignation of Kenny Parcel, former president of the National Association of Realtors, the industry is left wondering about the rest of the leadership. The new president, Tracy Casper, released a statement after an emergency meeting with the NAR Executive Committee on Thursday, saying that they're united in support of our staff, and that includes Bob. Bob Goldberg making about $2.5 million a year for being the CEO of NAR, which takes our dues and spends them for us. He came out and says, initial response from NAR and its leadership have been scrutinized, including Goldberg's statement to the New York Times, or the Times, during an interview when he asked the organization, when asked if the organization has issues with sexual harassment, Goldberg said, I would not characterize it as a problem.
Yeah. That's the problem. One of the problems.
All right. So fill me in on where you are in all of this, in your opinion.
I think that quote, I want to start with that quote. That quote, I would not characterize it as a problem, is so telling. According to my sources within NAR today, he sent out an email and basically said I was misquoted. Okay. BS. The New York Times recorded the interview. It's a verbatim quote. It's garbage and nonsense and a further pattern of lies and deceit that needs to end. Look, how can you fix a problem if you cannot acknowledge that you have a problem? You cannot. You cannot. We all know that there's a toxic culture now at NAR. The New York Times article was just the tip of the iceberg. For those of you who haven't read it, please go read it. If you don't have a New York Times subscription, please ping me on any of my social platforms at Jason Haber on Twitter, X, or Instagram. I'll gift it to you. Everyone should read this article. It's not one woman. It's not two. It's not just about sexual harassment, which is which is horrible on its own. It's about this larger culture of toxicity, of a good old boys network, which, by the way, involves both men and women who have not allowed for voices to be heard within the organization. They're bringing in I kid you not, I want to get this right, a cultural consultant who's meeting with staff to help them change the culture. They're bringing in a professor from Southern California, I believe, to help them with their culture. So they're bringing in a consultant so everyone can talk. So,
how many millions is that consultant making, by the way?
So like, if nothing's wrong, why are you bringing in the consultant? So now they're acknowledging
that's a great point.
Wrong, and that they weren't hearing people. They weren't listening to people. Look, all of this happened under current leadership. So I don't see how they can fix it. I'll spare you the 6 months of consultants and focus groups and whatever BS you want to go through. We've released at the NAR Accountability Project a 4-point platform, 4 policy proposals that, if you enacted today, would change NAR by tomorrow. And you could do it right now. Very simply, 4 things. 1, replace the CEO and change the leadership team. That includes replacing the general counsel, the head of HR, the people who are responsible for this culture of toxicity. 2, release women who have signed non-trade secret NDAs. The time for silence is over. Let them speak. Our dues paid for how many NDAs and payments? Whose money is that? It's ours.
Yeah.
Okay. Let's face it. We don't know how much was spent, and we should know. And those women should be allowed to speak their truth. 3, we're calling for a sweeping independent investigation by a law firm not affiliated with NAR or any of their affiliates. Think about what the Washington Commanders did recently when they investigated their own in-house.
Yeah.
A comprehensive investigation, top to bottom, to uncover the breadth and depth of what is happening within our trade association that we fund with our dues. Lastly, we're calling for a third-party HR system to be implemented. So when there is a claim, it doesn't run through the chain of command, which is what happens now. Instead, it goes to an outside third party for investigation. So this will empower folks so they know it's outside the chain of command, because there's no trust right now. So if you do those 4 things, and you could do them today, you don't need cultural consultants. You don't need to have focus groups. All of these ideas, by the way, are not mine. You know who they are? They're people who work at NAR or who used to work there or are contractors, because I've talked to over 35 of them at this point, and they all say the same thing. To change the culture, release the NDAs. To change the culture, we need third-party HR reporting. To change the culture, we need a new leadership team. To change the culture, we need an independent investigation. That's what you do. Do it now.
Yeah.
Save everyone the time. By the way, it will enable NAR to get focused on what matters, which is the last segment that you talked about. They shouldn't be having to focus on this right now. We've got a major lawsuit that will impact the future of our industry. Every moment should be spent defending the industry against those lawsuits. Now there's a cloud over the organization. We're losing the battle of public opinion. I mean, I don't know how low, the public feels about realtors right now, but it's dragging all of us down. Because if you're a realtor, you're now associated. It's like guilt by association. Yeah. Our trade association is failing us. And that's why we created the NAR Accountability Project. You can go to agentsdemandchange.com and sign up there if you'd like to be a part of what we're doing. We have a petition we're circulating right now with the 4-point platform. I'd love for you guys to sign that petition. Spread it, send it to at least 5 or 10 friends in the industry. We have a voice now. And before there was just silence. And that was why we launched this in the first place.
Yeah, it has been really annoying. Dusty says that she says, I know their influence in my local board is toxic AF. They don't care about the local agents and local info, but regularly silence local level agents they disagree with. And look, hey, the NAR Accountability Project is watching the show.
Look at that.
They can't silence all of us, Dusty. Stand together, we're stronger. I just wish our budget for legal issues was as high as theirs. Yeah, for real. Well, okay, so let's say, Jason, in a perfect world, that they make these changes. Yeah. It's less toxic there. I mean, that would be great. I think we could all agree that would kind of clear out a lot. I feel like there's still so many issues with NAR that even the accountability project, it can't end, because just in what BAM reported before all this Kenny Parcells stuff, what BAM was reporting about spending and how many people are getting rich off the dues versus what the agents are getting in return, and the consultants that they hired for advertising and marketing paying $47 million doing a job that I could have done with $2 million. I mean, it's a real issue. How do you start to dive into those issues?
So here's what's happened. The genie is now out of the box, or Pandora's box is open. Yeah. You can't put the genie back in.
Are you Pandora? You're the...
I think I opened the box, but now that, because no one was speaking, by the way, like real quick, when this story first broke 10, 11 days ago now in the New York Times, there was silence. No boards, no brokerages, no one was calling for Kenny Parcells to resign. When I first said it, I had the radical position. Now in hindsight, a whole 10 days later, everyone agrees with me that he should have resigned. Right. Like everyone eventually comes over to our position. So what 10 days ago was seen as a radical position is now seen as, that's the right thing to do. It's the same thing with my 4-point platform that we've launched at NAR Accountability Project. People at first are like, oh, well, this is radical. You're actually giving specifics, not just vague calling for change, but you're being very specific. Well, yeah. And now people are coming over to our side and saying, this is exactly what we need. And we need to do it now. So you have all these issues. And now once that is out in the open, everyone's like, hey, wait a minute. Like, what exactly are our dues going for? And where is the accountability within the organization? And so we're talking with a lot of our stakeholders now, and be part of this conversation by signing up at agentsdemandchange.com, because we're talking about these other issues, which no one talked about before, except for the guys at BAM. We're now going to say, listen, we're not only paying dues, but we're paying attention. And you have a responsibility to us. And so now that's a different paradigm. So it's not just the toxic culture that's going to change. I think everything's going to change.
That would be good that's really good. That would be great for the t-shirt. Pay attention, not just dues.
I think we're working on something, our voice, our dues. And then we have a whole bunch of swag in the works, but we just haven't gotten there yet because we've been, busy with
so for me, there's a lot of people like me out there that honestly hate the politics side of the job.
Yeah.
And the, getting involved in the political side is what it feels like whenever you're getting involved at a local board. And it's hard for some people. Well, it's hard for me. And I think there's a lot of people that kind of have this same attitude towards it because it just feels crummy. I mean, and it's like, it drains me when I have to think about, hey, I want to help my clients buy and sell a home. I want to help develop agents on my team and help them to have a better life by helping other people have a great experience in buying and selling a home. Like, that's what I want to do. What I don't want to do is get involved in politics.
Yeah.
So what's the link for people like me that are kind of out there saying, I just want to, this is what I want to do. And I have to be a member of NAR because locally, if I'm not a member of NAR, I don't have access to the MLS. I can't operate as a regular real estate agent here. What's your message to those people?
So the truth is that in silence and indifference, bad things happen. And so unfortunately, we do have to use our voices and our collective voices. What I would say though is now for the first time, there's actually a watchdog group that we've created that's out there more on the front lines. Agents shouldn't be on the front lines of this. They should be focusing on their clients' best interests, and then also lending their voice to join us as we have a grassroots9 agent advocate army out there. We have over 1,000 agents with us in just 1 week. 9 days ago, we had 5. And we have over 1,000 in all 50 states. We hit the 50 state mark last night, which was super cool for us. All 50 states. Okay. So this is a growing movement. And we're prepared to be the voice for the industry when we need to be, like we're doing right now. So we have no plans on going anywhere. We'll see exactly how this scales over time. But initially, we are focused on our 4-point platform. And for those in Chicago, we do have an upcoming day of action. If you sign up on our website, you'll find out when that's going to be exactly. But we'll be on the ground in Chicago soon, with elected officials, policymakers, advocates, women's groups, and we'll have a national day of action built around our events in Chicago, so we can all make our voice heard.
That's cool. The James O'Keefe of NAR. No. I'm just kidding. I do want to share the NAR Accountability Project, though. There's the website. Go there, put your email in, and join them. If you scroll down a little bit, you'll see the petition to sign, and then they update you. You can download the NAR Accountability Project social assets to share. And there's a directory. That's cool. I haven't seen the directory yet.
So that's if you want to contact your local. Yeah. So we have a directory. We have social assets, which we'd love for you to download and post them on Instagram, on Twitter X, and just, let everyone see the logo. It means that you're with this nationwide movement. It's all free, by the way. We have no dues.
Yeah, look at that. Dues. Imagine that. No dues, but accountability.
No charges. It's all free. We don't spam. We don't sell the emails. We just, every once in a while, you get an email letting you know what we're doing and how you can be a part of it. So
I love it.
It's all there for you.
Christine, hey, she said, what's the title of the article? Which headline? The one in the New York Times is President of Powerful Realtors Groups resigns after sexual harassment claims. If you search that, actually you could search NYT, National Association of Realtors, and find it.
So that's the second article. If you go to the NY, so if you want to read the actual investigation, just go to the New York Times website. The article is by Deborah Kamen, a terrific reporter at the Times. Really, really, really smart. But if you just type in Kenny Parcells' name, it's the first of the two that come up, and you'll see the headline there.
Okay, cool. And there's also a good article on you on Inman too. I'm going to share that real quick so people can see that.
Inman did a good one. BAM did also a really good one that sort of outlined our group very well. This one was from, I think, yesterday in Inman.
Yeah, Broke Agent Media, and also Inman has really good articles. If you can't get behind the paywall on Inman, go to the Broke Agent Media version. I will post links to all of those into the description, and we'll also have a link to the Accountability Project as well, so that people can get all the information there. Let me find the BAM article on that too. Where is it?
Yeah, we can share the link.
Yeah, I'll find it. I'm a contributor to BAM.
Oh,
I'll find that one.
Yeah.
Well, dude, I really enjoyed having you. Oh, there you go. That's the link. I'm assuming that link was posted there too. So thanks, NAR. I'm really glad you decided to join me today because, we've been, since the logo change, that they went to the 3D box logo and everyone made fun of it. It looked terrible. Right. And then they basically just changed it back and wasted a whole bunch of money. We've been tracking NAR, what's happening at the level. And there's a lot of our listeners that are just kind of fed up with them, but there's nothing that we were able to do. So I love to have something to rally around and direct people to say, hey, accountability is important. If we're giving you money, you should be accountable on how you're spending the money so that we can all see exactly what's happening. You should also be accountable to how your corporation is acting, especially if it represents all of us. So I love that you guys are here doing what you do, and we'll support you any way possible. And thanks so much for in 15 minutes jumping on being ready. It's so rad, man. I'm glad
that's awesome. Yeah. So we'll keep you posted once we have more information on the day of action. We're close to finalizing it. And let's keep the conversation going. I'd love for your listeners and viewers to come check us out at agentsdemandchange.com. Sign up, download the social assets, ping me on Instagram and Twitter and LinkedIn too. And let's get this done.
Yeah. And what's your Instagram again? Where can people find you before we head out?
Jason Haber, JASONHABER.
That's right. So you guys go follow him, give him a follow. You guys can find me at Ray Zorback. That's RAYZORBACK, because I am a Razorback fan, and it's also football season, so we're getting
That's right. Here. I think we just shared a link to the petition, by the way, if anyone wants to follow that link.
There you go. All right, so check that. We're also going to put all that stuff in the description for you guys. But thanks so much, everyone, for joining us. Thanks for the discussion. Thank you, Clubhouse, for joining us as well. And I will see you guys next